Good afternoon, everybody, and welcome to Scope's webinar on the UK sovereign and its UK social housing sector. My name is Dirk Brandenberg. I'm Scope's head of ESG and credit research, and with me today are Eiko Sievert, our lead analyst on the UK sovereign, and Brian Marley and Thibault Vaz, public sector analysts that, among other things, cover the UK social housing sector. As always, a couple of housekeeping items up front. We have the slides available for download. If you look at the bottom right hand of your screen, it's a little apps button where you can find the PDF file. We will obviously make a recording available as well after this call. And for anybody who has questions, please feel free to type them into the question box as we go along, and we will take them in order of their arrival. With that, let me just briefly introduce the subjects today. So we're going to talk briefly about the UK sovereign and our outlook, both for the rating and the economy here. Eiko has been the lead analyst for a while on the UK, and we hosted a webinar with him last November when we affirmed the UK sovereign rating. With a stable outlook. So with the AA, we are very much at the higher end of our peer group here. In terms of our economic outlook, we currently forecast the UK to grow or to shrink by 0.6% this year, and then to grow again in 2024. So that is more or less in line with consensus, although there has been some reasonably good news in recent weeks on the UK. So we also noticed that some of these consensus estimates are going up at the moment. And with that, I thought it was a good time for Eiko to talk us through his latest views, which he published on as well last week, and where we are going on the UK sovereign rating. Eiko, you want to take it on, please?
Sure. Thanks a lot, Dirk. And good afternoon, everyone. So as Dirk mentioned, I just wanted to give a brief overview of our views on the UK sovereign rating and highlight some of the challenges that the UK faces that are also directly relevant for the social housing sector. So moving to the first slide. So Scope affirmed the UK's AA credit rating in November last year, as Dirk had already mentioned, and we also maintained the stable outlook. And as you can see on the chart on this slide here, this contradicts with rating actions taken by many of the US rating agencies. And I'm sure most of our listeners will be familiar with the UK's mini budget last September that was announced by the Liz Truss government. And back then, the plan to implement unfunded tax cuts resulted in a sharp and immediate reaction from financial markets. And as a result, UK government bond yields increased and sterling weakened quite considerably. The strong reaction from markets and the resulting political crisis in the days after made it very clear to us that the policies announced in the mini budget were highly likely to change quite significantly. So we therefore decided to look through the short-term political volatility caused by this mini budget. And as expected, the UK government quickly returned to a somewhat more orthodox fiscal policy under the new leadership of Rishi Sunak. And this was a clear reflection of the UK's strong institutional framework, which we had highlighted in previous years for the UK as well. And particularly the Office for Budget Responsibility, which scrutinizes government spending plans, played a very important role here for the government to regain the trust of financial markets. On the left side of the slide here, you just see an overview of the UK's most important credit strength and challenges that we had identified, as well as the possible rating triggers. I'll touch on some of these now, but you can obviously also find a lot more details in the full rating report, which is available on our website, and we also have a link to this at the end of the slide deck. So those in the UK will be all too familiar with the sort of wave of strike actions that we have seen over the past year. I mean, they include transport workers, barristers, the postal service, the NHS, schools, universities, refuse workers, I think firefighters as well. I mean, I could go on, and I think there were some newspapers at the time that were publishing sort of weekly strike calendars just to keep track of the number of strikes that were happening. And the right-hand chart here clearly shows at least one important reason for these strikes. And that's real earnings in the public sector that have significantly deteriorated over the past 2 years. This also applies to the private sector since the escalation of the Russia-Ukraine war last year, but to a somewhat lesser extent. The main reason for this deterioration is clear. Inflation has increased rapidly since 2021. However, while this is clearly a challenge for the UK, other countries are obviously also impacted. So, for instance, Germany and Italy have quite similar levels of inflation to that of the UK. Our baseline assumption at the moment is that inflation rates in the UK and elsewhere will fall quite rapidly over the next 2 years, and reaching sort of most central banks' inflation targets by next year. Clearly, a related topic to the sharp rise in inflation is the reaction of central banks. So the increase in policy rates since January 2022 caused mortgage rates to rise quite sharply. This is unsurprisingly leading to a correction in the house prices, which have seen strong growth in recent years, and the latest data has already shown that there is the start of a fall in house prices in the UK. A question that often comes up is whether we might be facing a more severe market correction, so similar to what we, for example, saw in 2008. And at least so far, this appears unlikely. And as you can see in the chart, mortgage providers became much better at charging higher mortgage rates to riskier borrowers when compared with the sort of pre-2008 crisis. And you can see this illustrated in the charts. So pre-2008, all the lines were very close, very close to one another. And more recently, it shows that higher interest rates are being charged to sort of 95% loan-to-value mortgages when compared to, for example, 75% LTV mortgages. However, clearly a lot here will depend on how the inflation dynamics evolve over the next couple of months and year, and also, therefore, how the central banks react to this. And in my final slide, I promised to keep it to 5 minutes. So in my final slide, I just briefly want to also touch on the UK's fiscal position, which reflects some strength and also some challenges. So starting with the UK's debt to GDP ratio, which you can see on the left chart. This ratio still stands near an all-time high and is expected to rise over the next couple of years to around 101% in 2025. The better news is that while this debt level is significantly above Germany, which is obviously a AAA rated country, it is expected to remain below other AA rated countries. So, for example, France at 114%, or the United States at 126% of GDP. And then, as Dirk has referenced in his introductory remarks as well, there have been some positive news more recently in terms of the public sector net borrowing. This is likely to be around 30 to 40 billion less than what was expected in November. And it's, well, this is certainly welcome news, obviously. It is largely thanks to falling energy prices in recent months, lower government bond yields, and higher than expected tax revenues. So some of these drivers are sort of shorter term drivers, really. However, this doesn't mean that the government has significantly increased headroom to ease fiscal policy. So, for example, if inflation would fall more gradually, then much of the headroom could be eroded if interest payments on government debt rise faster than expected. Also, the improvement may be fairly short-lived. Simply, if we look at the sort of OBR 5-year forecast horizon, the fiscal headroom towards the end of that was already very small, and is likely to stay very small in next week's announcement. And with this, I would actually pause here already, Dirk, in case there are any questions, and so that we also have some time to dive deeper into the social housing sector.
Thank you, Eiko. Just maybe following up on your part, I'm actually quite intrigued by your optimism on inflation returning to 2% over the next 2 years, and just maybe circling back to the budget question, which is, I guess, on top of most people's mind this week and next. We had some better news from the UK, both in terms of, I guess, the sentiment around the economy, but we also had better fiscal receipts, better fiscal balance, better than expected fiscal balance than for the central government here. Yet we are overall in a shrinking, or at least forecast to shrink economy this year. We're running very high inflation at the moment. So, I mean, what fiscal position should the Chancellor take in his budget when it comes?
Yeah, sure. I mean, I can give a couple of points here. First of all, I mean, the fiscal space is likely to be quite constrained, and some of the things that he might put forward, which are being discussed quite a lot publicly as well now, is that there might be a slight extension of the energy price guarantee to reduce the high energy bills. If there was no action on the energy price guarantee, then we could face, or households could face, a 20% increase in energy bills from April. Because energy price guarantee is planned to rise from £2,500 to £3,000 per year for the sort of typical household anyway. Another area that's likely to get some attention is fuel duties. So in the past, those have been frozen several times. If there was, again, no action on this, then consumers would see a rise in prices of around 12p per liter at the pump, which would be a pretty staggering increase. I have to add here that freezing it completely would be quite an expensive policy. It would cost around 5 or 6 billion per year. So I'm not sure if there would be complete freeze, but at least some sort of lowering of that price increase is likely. And then there are other challenges that the Chancellor obviously will have to grapple with. So first of all, as I mentioned before, the strikes, so resolving some of these strikes, also raising labor market participation will get some attention, I think, to increase productivity. And maybe just one point to highlight here. So particularly the recent strikes by NHS staff have sort of reflect some quite structural reform needs that the healthcare sector has. And even though the tax burden in the UK is expected to reach a sort of post-World War II high of 37.5% over the next 1 or 2 years, I would expect that the government will face some quite difficult trade-offs here between either higher future taxes or a lower level of public services. And in the healthcare sector, there's likely to be a shift away from this completely open NHS to everyone potentially. At least these are some of the reforms that are actively being debated in NHS services as well. But maybe just to conclude, so overall, I would at least say that that this budget will certainly be less eventful than the last two, which I suppose is not a high burden. But I think that will be really important for the Chancellor is that he demonstrates that the UK can continue to meet its self-imposed fiscal targets, which I have to add have been actually eased after the mini budget last year already. So it will be very important for market confidence that these fiscal targets of sort of falling debt levels over the forecast horizon, that these will be met.
So yeah, thank you for that answer. So you didn't mention the word tax cuts or tax increases, but I suspect in your view, tax cuts are not really on the cards at all. Tax increases like the corporate tax and others, do you think that is necessary?
So on tax cuts, I think,
perspective.
Sure. So on tax cuts, I mean, there is certainly a need, and I mentioned before that there's this need to increase productivity in the UK and also efficiency. And so in terms of tax cuts, there may well be some shifts around corporate tax, particularly. I think there, so one area that's being discussed again very actively is the role of R&D tax credits. They probably won't be quite as favorable as in the past, where I think it was 130% R&D tax credits. But I think they will try to sort of target these a bit more specifically in some industries. So areas where the UK wants to be a champion, whether it's artificial intelligence or life sciences, or some of these technology sectors that the UK is trying to push forward. Obviously, the UK also has an extremely strong university base and world-leading universities, and those some further support here could maybe basically mean that these universities become incubators for for future growth and for future technology companies.
Okay, so you're encouraging some long-term thinking here for the UK government, which surely is appreciated.
I always do that, yes.
That is certainly the rating agency view. That's expected. Thank you very much, Aiko. That was a good introduction to our subject today, and you already sort of given me some important points here as I switch over to the sort of more intricate aspects of the UK social housing sector. So clearly, we've seen falling real wages. We have rising interest rates. We have potentially falling property prices. So not an ideal world to be involved in housing in any way, shape, or form. But clearly, social housing has been a key focus in the UK, not at least because of the lack of housing and the very strong preference by the government to build more housing, more affordable housing. So this is quite a key sector for the UK and also clearly for the UK budget ultimately. And with that, I wanted to hand it over to Thibaut Vass, who is a public sector analyst and specialist on our UK housing credits. Thibaut, you want to take it on?
Yeah. No, thanks a lot, Dirk, and welcome everyone. I wanted to touch upon a few of the aspects that Aiko discussed today. So what some of these macro trends actually mean for the social housing sector. And the first point I wanted to discuss was actually on inflation. So obviously for many other sectors and including the social housing sector, it is a challenge. But it is particularly so for this one because there are several important cost items that have increased at a higher rate than average CPI. So that's been true generally for construction prices since around 2012. But more recently, over 2021 and 22, we did see a remarkable increase in the costs of materials for repair and maintenance, which is quite important for the sector, given the increasing spend in that area. Now, inflation on these items has eased somewhat, and we do expect inflation to come down in coming years. But it is an issue for the sector. And those cost pressures are being compounded by changes in rent policies, which you see on the right-hand chart, which basically shows how CPI and social rents have evolved in recent years relative to their 2015 levels. And the dotted lines that you see here show how social rents would have evolved under different government policy settings because we've seen quite a bit of volatility, let's say, in terms of rent policies. So more recently, following consultations with the sector, the government revised its rent policy from the original plan of increasing rents by CPI plus 1%, and capping them at 7% for the coming year. So we think that that was an important measure to take in terms of mitigating the cost of living crisis for tenants, certainly. But it is leading to less dynamic revenues for the sector. So the losses that have been estimated by the government for registered providers is around £3.2 billion over the next 5 years. So roughly about 2 to 2.5% of turnover. Now, I do want to nuance this point a bit by mentioning this. So the sector has previously had to face what I would argue is a more challenging and unexpected shift in rent policies. And that was the requirement to decline rents over the 2016-20 period. The orange dotted line that you see here actually shows how rents should have evolved under a settlement that was agreed in 2013. So the government at the time did provide a 10-year view on how rents should have evolved over the 2015-25 period. And it foresaw rent increases by CPI plus 1 at the time. That changed in 2015 when the government asked providers to reduce rents. I mentioned this because the main point for me is that the recent policy shift, it's not inconsequential, but you actually see here that the impact in terms of long-term financials is actually much smaller than the policy shift that we observed in 2015. And in general, what we find is that housing associations are well-governed organizations, and they've demonstrated their ability to adapt to an evolving and challenging operating environment. So there is a bit of nuance here to bring. And Brian will elaborate a bit later on what adaptation can actually mean for the sector. So that's for inflation and rent policies. On the next slide, I wanted to just discuss a few of the key credit metrics that we look at and discuss some multi-year trends. So what we see is that the decline in social rents that occurred between 2016 and 2019 resulted in sector-wide deterioration in a few, but not all credit metrics. So it's mostly about profitability and especially interest cover, where we've seen this deterioration in recent years. Now there are a number of providers that have interest cover that is inching closer to the typical loan covenant thresholds. So it's typically between 125 and 110%. There are discussions ongoing with lenders regarding some of those covenants, so waivers, certain exceptions to how you actually calculate the interest cover metric. But that's where we're seeing more pressure, let's say. When it comes to gearing, the story has actually been one of broad stability, despite substantial increases in debt. So there's been a commensurate increase in providers' asset base as they've issued debt to develop housing assets. Now, this may change in coming years because associations need or may need to take on more debt to invest in existing stock rather than new developments. That being said, gearing in general for the sector tends to be overstated. So housing assets for social housing providers are typically undervalued. So there is a lot of hidden value there in the sector, even if it can sometimes be challenging to quantify. The main point being that there is borrowing capacity for these type of organizations. Now, on this slide, I did want to discuss the exposure to the housing markets because, as Aiko mentioned, it is where we're seeing potentially, yes, a downturn. Now, what you see is that it varies greatly among providers. So the median for the share of housing property sales in terms of turnover is around 7%. But for some, it does start to reach quite substantial levels. So over 15, 20, 30%. So we do think that market sales are a good way for provider to diversify their income, to cross-subsidize their social housing activities. But in the current context, it does represent a risk factor. That said, we're not expecting a prolonged housing market crash. And on top of that, housing associations are patient investors. So should there be a downturn in the housing market, we expect them to hold on to their assets perhaps longer than initially planned, but rather than actually selling them at unfavorable terms. But nevertheless, this revenue stream will certainly be less dynamic in the near term. Now, what I've touched upon is mostly near-term pressures related to some of these macro developments that Aiko mentioned. For us, it's in terms of credit, what we do focus on is more long-term challenges. And I think these two charts illustrate what we view as the more fundamental long-term challenge, which is the erosion of forecasted profitability and interest cover. And here we've seen that there's been a consistent decline in the interest cover that providers are forecasting for the next 5 years. And the main driver of this has been the need to increasingly spend on existing stock. to meet environmental, safety, and also quality standards. So we do see this as being one of the more important challenges for the sector today. And it is resulting in, let's say, a policy trade-off for the government that is sometimes complex to navigate. And this is actually what Brian will cover in his part. So I'll leave it here and pass over to you, Brian, for the rest. Thank you.
Thank you, Thibaut. Good afternoon, everyone. So, yeah, to put these challenges that Thibaut mentioned into perspective, as he said, these trends will make it harder for housing associations to meet two key government policy objectives. So, investing in existing stock to meet higher quality standards, all the while delivering new affordable housing supply. On the first front, regulatory pressure has increased significantly here in recent years and is pushing providers to invest in their existing stock to raise quality levels. Over the near term, this primarily relates to fire safety repair works. So here, spending has been ongoing since the Grenfell disaster, and generally, housing providers have made good progress over the past few years in both assessing their stock and completing safety works. But this comes at a significant cost, and there is still a lot of work that remains to be done. In numbers, the National Housing Federation estimates that associated funding costs stand at about £10 billion for England. While these fire safety works are the most urgent capital expenditure pressure, the efforts from the sector towards decarbonization represent much more substantial investment needs over the medium to long run. So first, specifically on energy efficiency, the government target here is that all affordable housing is to be upgraded to a minimum EPC level of C by 2030. So as we can see on the left-hand side here, that means that around a third of the total affordable housing portfolio will have to be upgraded by then. And more broadly, on the overall effort towards decarbonization of the existing stock, here the government has set a goal of reaching net zero carbon emissions for all homes by 2050. For English housing associations, total associated costs stand at an estimated nearly £50 billion. So housing associations have to meet these tighter quality standards, all the while fulfilling their core mission and addressing the structural undersupply in affordable housing in England that Dirk mentioned earlier. So this is a long-standing issue, and it's estimated that England needs to develop around 145,000 affordable homes a year to tackle high demand and accumulated backlog of undersupply. This persistent undershoot that we see on the left-hand side is the reflection of a significant capital funding gap in the sector as a whole, which is estimated at about £34 billion a year. And overall, when faced with these two policy objectives, a lot of providers will have to make trade-offs. But if they significantly underperform on either, they become at risk of either regulatory action or reputational costs. Here, our methodology provides us with a degree of clarity on how exposed individual providers are to these challenges. So especially under our ESG risk profile assessment, which allows us to look at the housing stock's environmental profile and to assess the safety and quality levels of the portfolio. And importantly, also, this lens also allows us to account for the credit positive aspects of these capital expenditures. So even though these investments are not expected to generate significant additional cash flows, they will still reinforce certain aspects of the credit risk profiles of providers thanks to stronger asset quality. Yeah, a last one on my side to mention the three main options that providers have to bridge this gap. First, debt funding. It's more readily accessible, and we have seen robust investor interest in this sector, especially in relations with ESG finance. though as we can see here, aggregate sector debt has already increased over recent years, and it won't be possible for some providers which are close to their borrowing limits. Second, equity. So housing associations are constrained by their non-profit nature, so they cannot raise equity on their own balance sheets. But it is possible for them to partially offset this rigidity by entering into partnerships or joint ventures with other entities, and that allows them to establish cross-subsidy mechanisms, for example, to develop home built for sale. And finally, government funding. Here we see the years of steady decline. We have the government has increased subsidy levels in recent months, so especially following the new affordable homes program, but it remains quite low relative to the funding gap that we have outlined. Maybe a few brief concluding remarks on my side before passing it over to Dirk. All in all, the new operating environment will be harder for English social housing providers to navigate, but we see a number of key strengths that will allow them to face these headwinds, in particular related to the solidity of the institutional and regulatory framework, and the strengths of the governance standards. So Thibaut mentioned this before, but housing association and their governing bodies are used to adjusting to new operating conditions, and they conduct regular stress testing exercises. So looking ahead, we'll expect them to adapt their business plans in line with the constraints that we have outlined. Thank you.
Oh, thank you, Brian. That was a good overview here from Thibaut as well. Maybe get to the crucial question here. So, I mean, how should we assess housing association credit here in the UK, given where we rate the sovereign on one hand, and then sort of where fundamentals are headed, which you outlined quite well in your presentation. So how does Scope look at the linkages, and how do we look at the actual ratings of housing, social housing companies in the UK?
I think, yeah, we have a slide on this in the annex. So in a nutshell, any potential change in the sovereign rating would be captured in the uplift factor section of our methodology. So I won't go too much into the details, but this factor is a function of the government capacity to provide an uplift as measured by the differential between the provider's baseline rating and that of the sovereign. So a downgrade of the sovereign would result in a lower differential. Maybe important to highlight here is that this impact would be assessed on a case-by-case basis, so differentiated depending on the provider's own risk profile, and it would not be a blanket downgrade of the sector necessarily.
And relative to the sovereign, so we have the sovereign at AA. Where would that put the typical social housing provider? What rating range would it put it in?
That's hard to say. Here on the table, you can see, for example, so a lower rated, in essence, what this table would show is that a lower rated housing association would have more leeway from the downgrade and would be less impacted. And conversely, a higher rated association would be more impacted because the differential would be lower.
And the absolute differential was the range where we're having between I mean, the range of ratings we have relative to the sovereign rating.
Pardon?
The difference between the sovereign rating.
Yeah.
I mean, clearly some of the housing companies are rated BBB, I believe, out there. Some people are concerned they could give him lower. What is this?
Well, here
investment grade assessment, or what are we looking at?
Here, this would also depend on the willingness to provide exceptional support. So the second part of this factor, but in a triple B baseline, here we are at above 4-notch differential. So in most cases, this would not lead to a downgrade.
And maybe just to add, Dirk, I mean, for our rating universe, what we're seeing, so obviously there is a bit of heterogeneity, let's say, across providers. As you mentioned, there are some that are stronger than others. We tend to see that in general, we're around the single A area, at least for our rating universe, which tend to be the larger associations. There are a large number of smaller associations that we don't necessarily look at that could potentially be weaker. But for us, on average, we are around the single A mark.
Okay. Thank you for clarifying that, Thibault. I mean, another question was actually, and you mentioned it before, they tend to value their assets rather conservatively, but also they also have a lot of capex potentially requirements there. I mean, and then they rely on asset sales in some cases and the gains from that. I mean, what's our view? I mean, what do we factor in terms of house price inflation when we look at the sector at this point?
Sure, maybe Aiko, I see you've unmuted yourself. I think that's more of a big picture macro view, so I'll let you take it.
So I mean, in terms of house price inflation, I'm guessing you mean what our expectation is for house prices, and how much they might drop, if I understand correctly. So while we don't produce sort of specific housing sector forecasts officially for every country, my expectation would be that we might have a price correction of around sort of 7 or 8% in the UK. That's a bit lower than in some other countries. So, for example, if we took Sweden, we're expecting a more significant house price correction there. This is quite a lot shallower than what we saw in 2008, where you had a correction of sort of around 20% or so. So the correction at the moment, based on our sort of inflation and interest expectations, I would put at around 7 or 8% market correction. Obviously, that depends if inflation ends up being much stickier than expected. Then the central bank might be inclined to either raise interest rates or keep them high for longer, and that could then cause a slightly more significant correction.
Okay, thank you. Maybe going on to the sort of revenue side of the social housing companies. I mean, you mentioned it in your part, Thibault, that rents already were capped below inflation this year, and there have been several revisions in terms of the path of rent increases here over the years. Given this sort of extreme cost of living crisis that has sort of ripped through not only the UK, but certainly had a big impact here. I mean, how do you expect that to affect the sort of options that housing associations have going forward here in terms of managing their P&L and these investment needs as well that you highlighted?
Sure, thanks, Dirk. So I think there are two dimensions to what the cost of living crisis means for the sector, at least as it relates to their tenants. So one is obviously the social aspects. It is quite frankly, the crisis is terrible for social housing tenants. They already suffer from the highest poverty rates of any housing tenure. They are being particularly hard hit by this crisis, and there is genuine concern among tenants about being able to meet their monthly expenses, and rent is a big part of that. So that is part that relates to the social mandate of the sector, and they are playing a big role in terms of helping their residents navigate the crisis. So housing associations provide support services to tenants, with understanding what the impact of the crisis could have on their bills, providing financial advice. Some have pledged substantial financial amounts to actually support their residents in the current context. So that's one aspect where they are playing a role in terms of mitigating the crisis for their residents. Now, from a financial perspective, the risk is increased arrears. So what we've seen so far is that they have increased somewhat in 2022, but they have stabilized in the last quarter. So right now, arrears and rent collection is actually still better than the peaks that we saw during the height of the COVID-19 pandemic. Now, on top of that, I think the pandemic was actually a good litmus test in terms of the support services, but also in terms of driving housing associations to be a bit more proactive and innovative in the management of arrears. And now, that being said, the majority of providers now are actually reporting that arrears and rent collection is either in line or outperforming their business plans. Last time I checked, the median arrears for this sector in December of last year was 3.4%. In 2019, it was 3.2%. So it's something we're monitoring. It is a concern that arrears could increase, but I would say it's not the biggest risk factor right now. So in terms of P&L, the other dimensions that we mentioned are more substantial, let's say.
Okay, thank you. Aiko, anything to add? I mean, what's the policy view here? What the UK government is going to take? Redistribution, housing shortages, cost of living. I mean, how important is the social housing sector, and what kind of policy impact do you expect here?
Yeah, I mean, from a policy perspective, of course, the social housing sector is quite a high priority for the government. I mean, just maybe more as a general point, obviously, lower income households tend to be the hardest hit from high inflation. This is the same in every country, basically. I mean, it's largely because of the big increase in gas and electricity prices, but also food. It means lower households have less ability to switch to cheaper goods or services. And I think if you look, for example, at the total spending, the lowest income households are, I think, almost 3 times as exposed to energy costs as a higher income household, simply because it takes up a bigger share of their income as well. Obviously, what is not included in the normal inflation figure is sort of mortgage costs as well, which tends to be less relevant for the lower income households, but is important for the dynamics in terms of house prices as well. And particularly so this basically therefore applies for better off households, or at least households with a higher household income, and especially the sort of younger mortgage borrowers. So those are sort of those that are classed under the age of 45. They tend to have much larger outstanding mortgages, obviously. And even though in the UK there has been a broad shift over the past couple of years towards longer fixed-term interest rates, so the sort of 5-year fixed-term contracts rather than the 2-year contracts, there's still an estimate that around 1.4 million households will come to an end of their fixed-rate deal during 2023. So that gives you an idea of the number of households that have to renegotiate their mortgage during 2023, which is when a lot of these sort of higher interest rates will hit. So in terms of consumption dynamics and therefore economy dynamics, this is why our forecast for the UK at the moment is still for a recession for this year. And I'm not sure if that answered your question fully, but if not, then
no, I think the question, the underlying question here is how much political support there really is going to be going forward. For the housing sector. And also, I guess, I don't know to what extent you guys can actually comment on that, because is this a particularly strong point here in the UK, let's say, compared to housing providers elsewhere, if there is any comparison possible at all, which frankly I'm not 100% sure. But I mean, how strong do we see that backdrop here, the political backdrop?
So I think the political support for the housing sector, for the social housing sector, is there. I mean, whether you consider the Conservatives or Labour being in power, the Conservatives obviously have had this big success during the last election to break through this red wall election region, and therefore to maintain some of these seats. I think the social housing sector will continue to be an important focus. So it doesn't matter whether it's a Conservative government or a Labour government. I think it will remain an important area to support the sector.
Mm-hmm. Okay, good. You mentioned it, the young buyers, the sort of more highly leveraged buyers. Is there any views we have, Thibaut or Brian, on how we treat shared ownership here in the UK, both in terms of as a source of revenues, I guess, or as a source of support for our assessment of housing companies?
Sure. So we discussed how one metric that we look at in terms of exposure to the housing market, shared ownership sales are a part of that. We know that the government is increasing the focus in terms of fostering more development of homes for shared ownership, precisely to address some of the issues that the country is facing in terms of access to housing. So trying to foster an environment where UK households can actually achieve ownership. So that we know that is a focus for the government, and it's likely to become an increasing part of the business models of social housing providers. That being said, we do think that because, again, exposure to the housing market can underpin, let's say, a certain degree of risk. The basket of risks for shared ownership isn't the same as traditional social housing letting. So we do, let's say, put an emphasis on whether the providers have in place good governance to be able to understand and manage those risks appropriately. And generally, we find that is the case. So yeah, I hope that answers your question.
Okay. All right. Great. Well, that's very good, and thank you for fielding these rather difficult questions we got here today from the audience. So clearly, very focused investor audience here. But we are slowly running out of time here after 45 minutes. So that leaves me, first of all, to thank you, the presenters here today. That is Eiko, Thibaut, and Brian. And then obviously also our audience for staying with us today. So I hope to all see you soon on another occasion on the Scope webinar. Thank you. Bye-bye.
Thank you.